everyone, and welcome to another options trading educational video here from OptionsPath. Today we're going to give a quick introduction to one of our favorite options trading income strategies, the credit spread. Now, simply put, the credit spread is one of the best ways to build a regular income using options. It can keep paying you week after week and month after month at very limited risk to your account, if it's done in the correct way. Now, one of the great things about this strategy is that it can provide you with a huge margin of error on each trade. You don't really need to predict where the market is going, just where it probably will not go in a short amount of time. And as you'll usually be right the majority of the time, you can get paid well on a very regular basis. In the uncommon but inevitable outcomes where the market insists on going where it wasn't supposed to during the short time duration of the trade, you can simply adjust your position and potentially make even more money overall on the trade. This is the definition of high probability intelligent trading. All that needs to be done is simply to trade the credit spread with a couple of very simple steps, often on a broad stock market index like the S&P 500, and you'll immediately earn a substantial fee called a premium for doing so. If all goes well and the market doesn't go where it's unlikely to go, as is usually the case, the premium payment is yours to keep free and clear. This could be within the span of anywhere from a week to a month or maybe a bit more, depending on how you decide to set up the trade. You could also have several credit spreads on simultaneously, staggered in time, in order to supply you with as frequent an income payment as you would like. Okay, so what exactly is a credit spread? A credit spread is an option strategy that involves a purchase of one option and a sale of another option of the same type, underlying stock, and expiration date, but different strike prices. Credit spread sellers receive a net premium credit for entering the position with the goal of having both options expire worthless to keep the net premium. A credit spread can be either a call spread or a put spread. Now, to provide an illustration, let's take a look at the SPX chart, which is essentially the S&P 500 stock index. A call credit spread, also known as a bear call spread, is accomplished by simply selling a call to earn premium at a strike price somewhere above the current market price, right up here on this example right here, and simultaneously buying another call at a strike price above the sold call right here, to limit risk by paying a smaller premium as a kind of insurance policy. So as we can see here, we have the sold strike here, and then we have the bought strike right up here. Since the premium for the sold call is greater than the premium for the bought call, the result is a net positive premium that goes immediately into your trading account. And your risk is strictly limited to the difference between the two call strike prices. So right between here is your risk. In contrast, a put credit spread, also known as a bull-put spread, is accomplished simply by selling a put to earn premium at a strike price somewhere below the current market price, right down here for this example, and simultaneously buying another put at a strike price below the sold put to limit risk by paying a smaller premium as a kind of insurance policy, for example, right down here. Since the premium for the sold put is greater than the premium for the bought put, the result is a net positive premium that goes immediately into your trading account, and your risk is strictly limited to the difference between the two put strike prices, right between here. And by the way, if you have two of these credit spreads on, the bear call spread and the bull put spread, that's actually called an iron condor. Now, the really great thing about these credit spreads, along with other high probability options trading strategies, is that once they're learned and applied consistently, they become a virtually automatic way of earning a high income from the markets with limited risk and defined risk. But in order for them to work properly and optimally, you really have to learn exactly what to do when your trades are threatened in any way by the often very unpredictable markets. Again, this is where the all-important trade adjustments come in. Without trade adjustments, any losses can wipe out the profits from several previous trades or possibly more. But adjusting credit spread trades is a bit beyond the scope of this short video, so we'll address it on another video. Okay, let's show some quick profit and loss diagrams for bear call spreads and bull put spreads before we get to some examples on the actual trading platform. Here we have the bear call spread P&L, or profit and loss. And as we can see here, we have the short call strike price right here and the long call strike price right here. Now, as we mentioned, if the price stays below the short call strike price by expiration or by the exit of your trade, then we could see that we could get max profit. Now, once it goes above your short call strike price and then above the long call strike price, that's where you get your max loss. And here we have the bull put spread P&L, or profit and loss. Now, as we can see here, we have the short put strike price right here, and we have the long put strike price right here. If the price of the underlying, in this case the SPX, stays above the short put strike price by expiration or by the close of your trade, then we could see that we may be able to get max profit right here. If the price of the underlying goes below the short put strike price and then below the long put strike price, that's where we could get the max loss, as we can see here. So now that you have a bit of background on credit spreads, let's move on to what's called an option chain to place our trades. For these examples, I happen to be using the popular Thinkorswim platform, but you could pretty much use whatever platform you prefer in a very similar manner. An option chain is simply a list of strike prices for a specific expiration date where you could choose your strikes to trade credit spreads. If I want to trade a bear call spread, for example, I could look on the call option chain for the expiration date, let's say around a month away. So as we can see here, I have 29 days on this specific expiration date, 29 days until then, and I could look on the option chain for the calls, and this is right here. So I'm going to go down and look for a strike price that I would like, and right down here is one that I would like to do. I would choose how far away from the current price to sell the credit spread, and then just go to sell a credit spread, or a type of vertical spread as it's called here. I would simply right click on the short strike, go to sell, and then go all the way up to vertical as we can see here, and out pops the order entry tab right here. And then we could choose our different parameters, including the number of spread contracts right here, and then the width of the strike prices right here, and the amount of net premium we would like to get right here. And this is the current price, as we can see. And this may or may not get filled according to what price or what premium you're asking for. Then we could go ahead and place the order by clicking on Confirm and Send. If it does get filled, we'll earn the net credit into our account immediately. All I want now, after I place the order, is for the market price to stay away from my call spread until expiration, or until the trade is exited early. Now, trading a bull put spread is very much the same thing, just in an opposite manner. I would look on the put side of the option chain, right over here, and then choose my strike prices. So I would go up, and let's say I want the 1950 right here for my short strike price. I would simply right click, go to sell, go to vertical, and out pops this window right here, and this is the current market price. Now I would then choose my different parameters, including the number of spread contracts right here, the width of the strike prices right here, and then the amount of net premium, as we can see right here, that I'd like to receive. Then I could go ahead and place the order by clicking on Confirm and Send, and this may or may not get filled, as I mentioned before. Now if it does, I'll earn the net credit into my account immediately. Again, after I place the order, all I want is for the market price to stay away from my put spread until expiration, or until the trade is exited early. So there you go, just a quick and simple video on trading options credit spreads, one of our favorite income strategies. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward on our website at OptionsPath.com. And from all of us at OptionsPath, thank you very much and have a great day.